welcome to all of you to the Q1FY22 earnings conference call of Coforge. You would have received our results by now. Those are also available on our website, www.coforgetech.com. Present along with me on this call are our CEO, Mr. Sudhir Singh, and our CFO, Mr. Ajay Kalra. We will start this forum with opening remarks from our CEO, and post that, we will be happy to open the floor for your questions. With that, I would now like to hand over the floor to Mr. Sudhir Singh, CEO, Coforge Limited. Over to you, Sudhir.
Thank you, Abhinandan. And a very good evening and a very good morning to you across the world, folks. Thank you very much for taking the time and for joining us for this conversation today. These are remarkable times that we are living through, and I hope that your family, your loved ones, your team members, and you yourselves are safe and healthy. We meet today, yet again, in the continued shadow of a pandemic that is still raging in parts of the world. The quarter under discussion coincided with the second wave in India. Team Coforge responded to the situation by establishing 3 ICUs within its premises across cities, by structuring 24/7 ambulance on-call services, and by conducting 32 vaccination camps across India. As a nod to the times, let me kick off the discussion today by sharing a rather unusual metric, one centered around vaccination rates. At Coforge, I take great satisfaction in reporting to you that 72.3%, that's 72.3% of our employees globally have now been vaccinated, and we are on target to complete the vaccination of all our employees who wish to be vaccinated by the end of the current quarter. With that, I would like to share some perspectives on our quarterly performance and the outlook going forward. Before I discuss our Q1 results, I would like to point out that this has been the first quarter where our reported performance also includes 2 months contribution from SLK Global, an acquisition that we closed in the last week of April this year. In order for you to better appreciate our operating performance, I shall call out organic performance not including SLK Global metrics, and I shall also call out the firm's overall performance including SLK Global metrics separately where relevant. With that, here goes. We are pleased to report that our organic growth as a firm accelerated further during the quarter. In Q1 fiscal year 22, our sequential organic Q1Q growth was 7.6% in US dollar terms, 7% in constant currency terms, and 7.4% in Indian rupee terms. This organic sequential 7.6% growth in Q1 follows a growth of 7.1% in US dollar terms previous quarter. As a consequence of the sustained growth that the firm has seen, our year-on-year organic growth in Q1 fiscal year 22 is 32.3% in US dollar terms. In Q1, our organic revenue stood at $185.1 million US dollars in reported terms, and the reported revenue in Indian rupee terms was 13,546 million. The firm's overall performance, including the contribution from the acquired SLK Global business, saw reported consolidated revenue grow by 16% quarter on quarter and 42.8% year-on-year in dollar terms. In Indian rupee terms, the growth for the firm in Q1 was 15.9% quarter on quarter and 38.3% year over year. Overall, consolidated revenue for the firm for Q1 stood at US dollars $199.7 million and Indian rupees 14,616 million in reported terms. With that, I shall now detail the vertical-wise growth for the quarter under review. The numbers I'm going to talk about now are excluding the impact of the SLK Global addition. Not including SLK Global as noted, in quarter one, our insurance vertical grew 10.1% sequentially and contributes 32% to the revenue mix. The BFS vertical grew 3.2% sequentially and contributes 16% to the total revenues. Our travel vertical grew 15.8% sequentially and contributes 20% to the revenue mix. The other verticals grew 2.1% sequentially, contributing 31% to the total mix. Our top 5 clients, not including clients from the SLK Global portfolio, grew 3.9% quarter on quarter, and our top 10 clients grew 5.6% quarter on quarter. Our top 5 clients contributed 24.6% to our overall revenue, and our top 10 clients contributed 35.9% of the total revenue. Our on-site revenues represented 60% of the total revenues in quarter 1 fiscal year 22. This indicates and follows the continuing trend of a gradual rise in offshore revenues over the past 4 quarters, with on-site revenue at 60% now being lower than the 64% recorded around a year back. Moving on to margins and to operating profits. During quarter 1, we delivered an EBITDA of Indian rupees 2,359 million before accounting for ESOP costs and the part of the SLK Global acquisition related expenses that got booked during the quarter under review. EBITDA margin for the quarter stands at 16.1%. The margin performance for quarter 1 fiscal year 22 reflects the full impact of global annual wage hikes rolled out across the organization with effect from April 1st. They also reflect the impact of transition expenses in 4 of the 5 material deals signed over the last 6 months, and also the movement of some AdvantageGo license sales into the next quarter. We do expect margins to expand substantially over the next 3 quarters, with quarter 2, which is the quarter that we're currently in, expected to be around 200 bps higher than quarter 1 margins. Our consolidated reported after-tax profit for the quarter stood at Indian rupees 1,236 million, a decrease of 7% quarter on quarter, and an increase of 54.7% year on year. The depreciation and amortization during the quarter also reflects amortization of intangibles created as part of purchase price allocation done for the acquisition of SLK Global that was concluded during the quarter. The impact of the same is $0.7 million in the current quarter, fundamentally reflecting around an impact of 2 months. Moving on to order intake and commentary around order intake. This quarter, the quarter under discussion, quarter 1 fiscal year 22, stood out as a record quarter for the firm in terms of composite order business. Revenues for this, of course, will be recognized over the 3 years around the licenses. In the BFS domain, the firm signed a $105 million contract to be delivered over 4 years, preceded by a staggered 8-month-long transition. The BFS deal will bring into play all our core transformation capabilities across enterprise architecture, industry consulting, data architecture, cloud engineering, digital integration, and intelligent automation. Out of this organic $318 million order intake, excluding the SLK business, the US contributed $46 million. EMEA was at $227 million, and $46 million was secured from the rest of the world. Finally, to round off this section, in addition to the 3 large deals that I referenced, we wish to also share that with one of the largest banking and financial services institutions in the world, we have signed a global MSA to provide technology services from and to their centers across US, Europe, and India. I shall now pivot to quick commentary around delivery operations and capability build activities. Today, more than 51% of our global tech revenues comes from our digital service lines. Another 20% comes from our cloud and infrastructure service lines. The firm's service stack today as a whole is a composite of a $100 million product engineering service line, $100 million cloud and infra service line, $100 million intelligent automation service line, with the addition of SLK, $100 million business process management service line, and a $50 million digital integration service line. The cloud services business continues to drive both accelerated growth and sharp differentiation. It also powers fully or partly almost every large deal pursuit that we are undertaking. Our engineering convergence-based agenda for the cloud that we've crafted, our own cloud innovation factory framework, our infrastructure as a core transformation program approach for the cloud, and our advanced AI ops platform, which is fundamentally an integrable, programmable platform, continue to deliver distinct and tangible value and differentiation in this space. Our product engineering service line with its Agile Next framework continues to power true product creation and upgrades. The AdvantageGo Specialty Insurance Suite is a prime example of this. This quarter, one of the world's largest publicly traded property and casualty insurance companies signed AdvantageGo for the implementation of our underwriting product. Another US-based Fortune 500 insurance company has successfully implemented our insurance risk management software. Within the broader digital practice outside cloud, also outside product engineering, for a global provider of risk management product and services, Coforge implemented a domain-driven design framework to modernize the API architecture of two of their crucial lines of business. And that in turn has helped them with a faster onboarding of their partners. Our digital consulting services team also leads our enterprise transformation offering for the largest independent global workforce deployment platform, which is incidentally a multinational conglomerate of over 7 companies. With them, we are engaged at the senior executive steering committee level itself to drive that transformation. And finally, to round up this section, on the recognition front, for the third successive year, we have been awarded the Platinum Partner status by Pega. Our digital integration business was awarded our 7th MuleSoft Partner Award to date, and we were also placed as a leader in the Everest Group Peak Matrix Insurance Business Model Innovation Enablement Services. Pivoting once again towards the people metrics, the quarter under review broke the record established in the previous quarter of the highest net headcount addition in a quarter in the history of our firm. On an organic basis, again not including SLK Global metrics, our headcount recorded a net increase of 1,138 people during Q1 fiscal year 22, implying a 9.2% sequential increase. This comes on the back of an 8.5% sequential increase in headcount during the last quarter. Effectively, total headcount for the firm, excluding SLK Global, has increased by around 18% over the last 2 quarters. On a reported basis, after adding in the 6,962 employees of SLK Global, who now form part of the Coforge family, our total headcount stands at 20,491. The strong headcount growth, allied with the significant number of employees engaged in transition activities to service the large deals and material deals that we've signed, has led to lower utilization during the quarter at 77%. You will recall last quarter we were at 81%. We expect utilization to normalize as newly secured deals start to ramp up. Finally, I'm happy to note that attrition continues to be at a healthy level, despite very tough market conditions around talent retention, and that it stays at 12.6%. Very quick commentary around balance sheet, and then I'll finally pivot to summing up and outlook. On the balance sheet front, cash bank balances at the end of the quarter stood at Indian rupees 3,017 million after material payouts towards the interim dividend recommended in May and the SLK Global acquisition. CapEx spend during the quarter was Indian rupees 520 million. The debtors at the end of the quarter stand at 71 days of sales outstanding. OCF for Q1 FY22 stands at $5 million. We are pleased to share that in line with our intent to return excess cash generated to shareholders, the board has recommended an interim dividend of rupees 13 per share. Summing up, and I'll follow the summing up with an outlook as well. Before I share the updated outlook for fiscal year 22, I would like to quickly summarize and reflect on the headwinds and also the tailwinds that drive our revenue and margin assessment for the year. On the revenue front, the tailwinds include 1, a 12-month organic committed order book, which is 20.4% higher than where it was a year back. 2, revenue momentum that has accelerated. The $20 million plus InsurTech win and the $105 million BFS win represent a material milestone for the firm. 3, our client concentration and the associated risk with that client concentration continues to be low and contained. 4, upfront resource hiring over the last 2 quarters has increased global headcount by 18% plus. This SME pool is available to staff the demand that we clearly see ahead of us. 5, and I think this is important, the increased recognition of our product engineering expertise and our ability to stand up, manage, and grow industry platforms independently continues to have a very positive rub-off on the services revenue stream of the firm. 6, again important, our forays into newer verticals over the last 18 months have now started paying dividends. We have stood up 3 material verticals in addition to our 3 core verticals over the past 2 years. High-tech and manufacturing now accounts for 8.9%. That's almost 9% of our global revenues. Retail and healthcare accounts for 8.1% of our global revenues, and government outside India accounts for 7.4%. 7th quick point, the continuing rebound of our travel business, and you've seen the metrics, gives us confidence. We believe this business shall see another fillip when the air travel in Europe rebounds. And finally, the portfolio of Fortune 1000 clients where we are enrolled as a preferred partner has doubled over the last 18 months. Growing these relationships alone reflects a material revenue expansion opportunity for the firm. Now, while all of these are favorable, on the headwind side, supply challenges are a clear headwind around revenue growth. We recognize and are attempting to resolve supply challenges, particularly supply challenges around niche skills. In May, we had shared that we are planning for an organic constant currency growth of at least 17% in fiscal year 22. You will have noted that our organic Q1 revenue times revenue multiplied by 4, just extrapolating, will by itself represent an organic constant currency annual growth of 18+%. Given this momentum and the backdrop that I just shared, we are now planning to deliver at least 19% CC organic growth for the year. Moving on to the margins outlook for the year, the tailwinds around margin include 1, the continued growth of and the discount reversal in our travel vertical. 2, a gradual increase in offshoring percentage as larger size deals have been closed. 3, the operating leverage that is coming from the accelerated growth that we've all seen. The headwinds on the margin side include 1, wage increase effective day one of the current fiscal. You will recall last year there was no wage increase. 2, retention cost and hiring costs increase. 3, a decrease in utilization, and this is important, we believe, as larger net new deals warrant upfront transitions and transition cost. You will recall that in May we had shared that we are targeting an EBITDA pre-RSU cost of 19% for the year. We continue to plan to target a 19% EBITDA as confirmed last quarter. In quarter 2 itself, we expect EBITDA to jump around 200 bps over quarter 1. This immediate jump in quarter 2 over quarter 1 will be facilitated by 1, a forecasted increase in utilization. Our global headcount has grown 18% in the last 6 months in an effort to staff our new large deals. 4 of the material deals signed in the last 6 months have an upfront transition period. In quarter 2, 2 of the 4 material deals will complete. The second thing that we give a short-term fillip is that the annual visa cost that we book in quarter 1 for the full year will not recur in quarter 2. 3, AdvantageGo license sales that were held up towards the end of quarter 1 have now been realized in July and will provide a fillip to quarter 2 margins. That's the aggregate summary on the margin front. Summing up, Coforge, the name that we adopted around a year back, stands for working together to create lasting value. We believe that at the core of our operating culture is an intense focus on execution and surprise-free operations. We believe that over the last 4 years, we have put in place the leadership, the strategy, the culture, and the tech capability stack to grow and differentiate. Moving ahead, we remain committed to building on the foundation that we created so painstakingly over the last 4 years. With that, ladies, gentlemen, I come to the end of my opening remarks, and I look forward to hearing your comments and to addressing your questions. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vibhor Singhal from Phillip Capital. Please go ahead.
Yeah, hi. Good evening, sir. Thanks for taking my question, and congrats on a great set of numbers yet again. Sudhir, just a couple of questions from my side. In terms of growth momentum that we see, I believe with the strong growth in this quarter, we are very well poised to actually cross the kind of guidance that we have given of 19% plus growth. In fact, if I do the math, I think the required rate for the next 3 quarters to meet that 19% growth is very low single digits, around 2 to 3%. In fact, even less than that. So just wanted to pick your brains on basically, is it that we're just kind of guiding it conservatively at this point of time, or are we seeing any headwinds, or are we being cautious about, let's say, a potential third wave, or the fallouts of any such events like in the second half of the year? Second thing, my second question was actually on the margins front. You very well articulated the breakup of how the margins in this quarter were impacted. So just wanted to check if you could just quantify the margin bridge for us in this quarter. So what was the basis point impact of the transition costs, visa costs, and the salary hike for us to be able to maybe build a bridge better for the future forecast?
Sure. Thank you. Thank you for the question, Vibhor. Let me just take both of them in order. You're right about the mathematical calculation around the growth required to hit the 19% threshold. It is a very low number. The intent, Vibhor, has always been to be conservative around revenue guidance, and that's how we've always offered guidance, and which is why we've always met guidance and in most cases exceeded guidance. That is the intent currently as well. we do not see any headwinds, material headwinds to revenue growth. And the intent will be to hopefully exceed the 19% threshold, which is why the guidance has been called out very clearly as at least 19% CC organic. Moving on to your other question about margins, Vibhor, the wage impact during the quarter had an impact of between 200 to 200 bits. Utilization, you noted, has fallen 400 bits. Every 100 bits decrease in utilization has a material downdraft on margins again. Advantage Go, and we always share those numbers during question answer sessions like these. The negative impact on the firm because of license revenue recognition getting shifted to quarter two is about 100 bits. So very high level, wage had a 200 to 200 bits negative impact. Advantage Go business, license revenue recognition, roughly about 100 bits negative downdraft. And utilization has gone down by about 400 bits. That again has had a significant impact. Finally, of course, there's a fourth parameter that I talked about, which was the visa cost that's all been booked upfront in quarter one. That too has an impact, but not as strong as the wage or the utilization factor.
Sure. That's great. Yeah, I think it's quite well answered. Just one last question on the recovery in the travel segment. We saw a very strong growth in the travel segment in this quarter. And if I look at the revenue from the travel segment for us in this quarter, I mean, we are actually, it fell sharply in Q1FY21. And then, of course, it had a proper V-shaped recovery. If I look at our revenue right now, it's around $38 million, which is just 10% less than what we were pre-COVID. So just wanted to pick your brains on the composition of this revenue. Is it that we have actually recovered almost most of the revenue that we lost and we are back to 90% of the pre-COVID levels in the same accounts? Or is it that those accounts in which we had lost revenue, that recovery is yet to come, but in the meantime we have added more accounts and that is what the recovery can be attributed to?
Yeah, so when we look at the travel sector from a geo perspective, across Asia Pacific and the Middle East, the travel recovery is near complete in terms of spend. In Europe, which is a very significant geography for us on the travel vertical front, the recovery is still in its early phases, largely because UK, where we have a material presence, airline recovery has not been on expected patterns, and hopefully that will start roughly about 2 quarters from now. US again has now started limping back to the levels that it was at pre-pandemic. So that's how I would represent the outlook for travel. Pre-pandemic, as you're aware, Vibhor, travel was about 29% of our global revenues. At the current point in time, it is 20%. And the one thing that's helped us recover has been the fact that now we have 3 other verticals which are between about 8 to 9% contributors for us, in addition to the first 3 that we've talked about. So that's how we see travel at the current point in time. Over the last 4 quarters, as you rightly said, the travel vertical, after the drop in Q1 of last year, has broadly been growing almost 7% sequentially for the last 4 quarters.
Right. So, great. Thanks for taking my question, and I wish you all the best.
Thank you, Vibhor.
Thank you. Before we take the next question, in order that the management is able to address questions from all participants in the conference, we request participants to please limit your questions to 1 per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Abhishek Shindatkar from InCred Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats on great execution. 2 questions. First is, just wanted to understand, how durable is this demand? Any comments, could be interesting. And the second question is, in the employee metric given in the presentation, the others, which likely is a staff has seen a substantial jump. Now, is this primarily related to SLK because it appears high for a captive business? And does it also create a lever for margins and growth? Thank you for taking my question, sir.
Thank you. Thank you for the questions, Abhishek. Let me take them in order again. At this point in time, when it comes to demand, there's been a lot of commentary that's been floating around, which talks about the fact that there is a material buoyancy in the demand environment, and that is accurate. When we look at the current scenario, and we try to project 3 to 5 years out and look at a scenario when demand will, I suspect, normalize, we believe that the capability matrix that we created over the last 4 years, the tech capability matrix around product engineering, is likely to see sustained long-term demand. Cloud is likely to follow the same pattern. Digital integration is going to follow the same pattern, we believe, as will intelligent automation. So while the market-based demand quite clearly is buoyant and at near peak levels or record levels, longer term for our tech services stack, we think there's a long-term secular high growth ramp on the demand side that we are seeing from the trenches right now. The same thing would apply if I were to flip this and talk about the vertical story. BFS innovation dollars continue to come in. Compliance dollars have been stable and at a high level. Insurance still seems to be in the early stages of pivoting towards longer term investments in the tech stack. And travel, of course, should, from the abyss that's been in, should for a few years be looking at significant demand because of cloudification picking up, because of touchless travel picking up, because of automated self-service picking up, because of security-related aspects picking up. So that's how we see the demand. We see it, at least from our vantage as a firm, as something that is durable, to use your words. As far as employees are concerned, your observation is right. There's been a step jump. That step jump has come largely because of, almost entirely is how I would characterize it, because of the SLK addition from the metrics that you saw last quarter. We believe SLK, and we called it out last quarter as well, we believe SLK in the short to medium term should be growing even higher than Coforge minus SLK, that portfolio. The intent is to keep these numbers static. We are not in the business of extracting people and taking them out, but we will, as we have done with Coforge, try to keep G&A static and drive accelerated growth so that as a percentage that cost keeps decreasing. But just summing up, your observation is correct. The increase in others has come from SLK. We plan to cap it at more or less the same.
In terms of the EBITDA margin guidance of 19%, so we have commented that there would be increase Q1Q in the next 3 quarters. But it looks like that there would be a heavy lifting still required in Q3 and Q4. And the Q4 exit rate on the EBITDA front should be close to 21% as a whole. So any risk to this? And if this is achievable, is it also fair to say that you may enter FY23 with 21% kind of an EBITDA margin as a whole, which will also set a stage about good margin defense, headwind defense in FY23 as well?
Sandeep, a little difficult for us at this stage to comment on FY23, but FY22 that we are in right now, our short-term focus is to make sure that we first get to around the 200 bits jump that we commented upon over the last quarter, and then try to extend it if it's possible to extend it, so that the ramp expected in H2 around percentage margins is not very severe. It takes some time for the initial wage increase impact, which tends to be significant, 200 to 200 bips, to get offset, and that happens progressively over the remaining 3 quarters, and we've seen that play out over the last many, many years. We expect discount reversals from the travel vertical to continue, and almost all of them to go away almost completely by Q4. On retention and hiring costs, the fact that we've done so much of it upfront to service demand that we've been talking about from almost the last 3 quarters should allow us to have some slack around being a little selective around how many folks we onboard and at what salary points we onboard. So as a composite, and I gave very detailed commentary around the headwinds and the tailwinds on margin. I talked in response to an earlier question around what the margin walk, what the impact of utilization, what the impact of Advantage Go license revenue is not being recognized, what the impact of the wage appreciation has been. As a consequence, when we look at the overall piece, we do think in the short term, as the Q2 plans play out around margin, and for the full year, 19% EBITDA pre-RSU cost, which is what we talked about, is definitely achievable.
Okay. Just a follow-up, in terms of after closure of such a great deals on an organic basis, how is the deal pipeline looking out? And still you are having deals above $50 million in your pipeline. And last question in terms of, if you look at the full year, generally your Q2 and Q4 are seasonally great. So do you expect the same trend may continue even in FY22? That's all my knowledge.
Yes, Sandeep. So the deal pipeline continues to be robust, and our intent, not just for this year, but in the years to come, it continues to be, as it has in the past, to drive growth that is robust, to drive growth that is sustainable and is not just a flash in the pan, and to drive growth at good, profitable, and over time increasing margins. Deal pipeline is robust, and of course, we closed a $100 million plus deal, and it's taken us about 4 years to come here, so we don't expect that to recur almost immediately. But as an aggregate, when we look at the deal pipeline, size of deals, number of deals, the spread of deals by tech horizontals and geos, we feel good about where we are. Q2 and Q3, and I noted this earlier as well, we do not see any headwinds which should result in any kind of a negative surprise against the plans that we have drawn for ourselves for growth for the current year.
Okay. All the best.
Thank you, Sandeep.
Thank you. The next question is from the line of Vimal Goyal from Union Asset Management. Please go ahead.
Thank you for the opportunity. Firstly, congratulations on a great set of numbers. Sunil, mostly you've answered most of my questions. I just had one clarification on utilization. If you could just highlight, given the kind of revenue growth that we've seen even organically, the reasons behind the fall in utilization. And you've sort of highlighted that utilization could go down further as you've highlighted that as a headwind. That seems to be a bit counterintuitive because as and when your employees are off the bench and on projects, your utilization effectively should improve. So if you could just probably help me clarify this mathematics. Thanks a lot. That's all.
No, thanks for the question. The two questions, Vimal, let me take them in reverse order. I just want to clarify, we believe utilization will go up. I have not indicated utilization will go down. What I did say was that utilization has gone down from 81% in Q4 to 77% in Q1. But we believe utilization will go up, and that is going to be a very critical and a very important margin lever for us going forward. So that's one. Coming to your first question around why has utilization fallen, 4 of the material deals that we've signed within the last 6 months are still under a transition phase, and that has warranted upfront transition investments in cost and in employees and people and SMEs. That's why utilization number has fallen.
Fair enough. Just one follow-up on the margins only. Sorry. So basically, your margin guidance of 19% post RSU, this is after the integration of SLK, which you had highlighted at the time of acquisition that this was an asset which had higher margins as compared to Coforge. So your margin guidance includes your SLK assumptions as well, I would believe.
Yeah, so when it comes to revenue guidance, we had always qualified it saying it will be at least 19% now at the end of this quarter growth. And as far as EBITDA guidance is concerned, we are targeting 19% as a composite organization because SLK is a relatively small part of the overall firm. And even if it comes up at higher than the firm's average, it is not going to move the needle too much. So 19% is the EBITDA target for the composite firm for the current fiscal year. And 19+% is the revenue target for the composite firm for the current fiscal year.
Perfect. Thank you so much and all the very best.
Thank you, Vinay.
Thank you. The next question is from the line of Manik Taneja from JM Financial. Please go ahead.
Yeah, hi. Thank you for the opportunity. And congratulations on a great quarter and starting FY22 on a very solid note. I had a couple of questions. Number one is on the deal wins in the US. Is there some one-off impact there, given the fact that typically we've had close to about $100 million of deal wins in the US on a quarterly basis? This quarter, that number appears to be low. That's question number one. The second question was with regards to how do you see the on-site offshore mix of your revenues progress more from a 2 to 3 year time frame, given the fact that we've had some offshore shift in the last 4 quarters and despite some of the large deals wherein you are transitioning currently? Thank you.
Thank you for both the questions, Manik. Deal wins, out of the $318 million, the fact that the US is $46 million in this quarter is just a passing blip. The one pipeline in the US is very strong. Our investments around sales and marketing addition have also been very, very focused on the US in the recent years. So the US should be back to near normals or higher than normal order intake starting quarter 2 itself. As far as on-site offshore is concerned, on-site revenue is now falling from about roughly what used to be roughly around 64-65% to 60% this quarter. If the deal velocity and if the median size of the deals going up, if that trend continues, we think on-site revenues might fall below where they are, or at least at a minimum stay where they are.
Okay. Thank you. All the best for the future.
Thank you, Manik.
Thank you. The next question is from the line of Mukul Garg from Motilal Oswal. Please go ahead.
Thank you. Sudhir, before I take my question, just wanted to share a feedback. Your revenue growth performance has been really exceptional, and while we understand and you have clearly laid out all the pulls and pushes on what is driving growth, it would be a lot more useful if the guidance can be a bit realistic. You guys are doing an amazing performance, and I don't think there is any harm in kind of portraying the growth you are seeing going forward over the next 3 quarters. Better than a flat type of a performance. So just wanted to kind of share that feedback. On the question, I just wanted to probe a bit on the margin guidance which you are giving. Is it possible to quantify the support from the shift of license sales to Q2 and reversal of discounts on the overall margin improvement, margin guidance commentary for FY22? And excluding these, is improved pricing one of the reasons why your margin will go up over the next 3 quarters? Or is this more a case of containment on the SG&A side?
Sure. Thank you. Thank you for the feedback, Mukul, and thank you for the question. Let me very quickly respond to the feedback. I think we, as a firm, we will take that as a backhanded compliment. The fact that you think 19+% revenue organic CC guidance is conservative. I do agree with the maths part of what you're saying. There is scope for us to perform better, and I want to assure you and to everyone else on the call that it is our intent to try to maximize growth. But thank you for that feedback. Coming back to your question around margin guidance and a more granular breakup of that margin guidance. See, license deferral from Q1 to Q2 had a negative 100 bps impact on our Q1 margin, Mukul. So that's something, as we think for the walk from Q1 to Q2, that's something that we have to factoring in. Discounts, especially in the travel vertical, continue to reverse. But as I noted earlier, we expect for the firm a material blip in margins owing to complete discounts going away, given how the pandemic has progressed of late, to happen around Q4 of the current fiscal. Third, your point around pricing improvements being a lever is correct. We have seen that, and this is still early days, a view from the trenches, that interestingly, and it's been a little bit of a surprise to us, interestingly, the ability to ask for and get higher price realization, especially for niche skills, this time around has been led by the APAC geography. So the willingness for clients in APAC to align with increased pricing asks is higher. I'm not saying it doesn't exist in Europe and North America, but it is higher in APAC. And we continue to have conversations with clients across North America and Europe, and also secure pricing increases. In our experience, those pricing increases are not across the board MSA linked for all skills kind of price increases. They are more structured around individual engagements or individual niche skill SMEs for whom prices are getting renegotiated. So that is how I would characterize the answer to the pricing improvement comment that you had, Mukul.
Thanks. The second question was on SG&A. There was a meaningful improvement or increase in the SG&A cost this quarter. Was that primarily because of SLK getting integrated into the organization? And second part is, if I look at the SG&A investments, SG&A payouts you guys have been doing, and I take a slightly longer term over last 4 years. It has very meaningfully trailed your revenue growth, at around 1.5% quarterly increase versus revenue growth, kind of almost reaching 4% on a QOQ basis between Q1FY18 and Q1FY22. So how should we see this? Because SG&A is always supposed to be more variable in line with the revenues, unlike a fixed cost, but the behavior and the performance is more fixed in nature. How should we see this going forward?
Mukul, if you look at our SG&A, and if I just reference the time frame that you're talking about, right, our SG&A from around fiscal year 18, it used to be roughly about 19%. In the quarter under review, it's come to 13.6%. So while there is a trailing impact that we talked about, the long-term secular impact as growth has accelerated for us is that our SG&A as a percentage has been coming down. 13.6%, which is where it is a number that to us seems to be a number that we would like to hold. We don't want to cut it beyond this, because it's not just this year. At some stage, maybe after Q2, we need to start sweating over next year and how to make sure that growth sustains and hopefully accelerates. So that's how we're looking at SG&A numbers right now. The 13.6% this quarter is lower by 40 bits from the 14% that we saw last quarter. The other interesting metric that you would have seen in the fact sheet that we shared with you is that the number of sales and marketing people have actually gone up. And they have gone up, one, not just because SLK got added to us. They've also gone up because as we've been creating newer verticals and as horizontals like cloud have started securing larger deals for us, we have started adding some of our existing delivery SMEs to the pre-sales pools of the horizontals, of the newer verticals that we created, and also the US Geo, which we think can be a very material growth ramp for us over the next 3 to 5 years. Did I answer your question, Mukul?
Clearly, that is a very fair assessment. So we just wanted to add this kind of context to this. Are you seeing any force multiplier because of your InsurTech platform on your SG&A cost? Because obviously the margins on product sides, are generally higher. So is that also one of the reasons why over a longer period you have been able to hold the cost while improving your revenues?
No, the biggest lever, as we assess it, Mukul, is the fact that over a period of time, right? If I look at current growth rate, we are almost twice as large as what we were 4 years back. So the biggest lever for us has been growth. Our SG&A costs have been rising, and they should keep rising, but they've been lagging, as you rightly said, the growth that the firm has experienced. That's been the biggest lever. I would not say that AdvantageGo, which is roughly only 5% of our global revenues, has been a very significant force multiplier on the SG&A side.
Understood. Thanks a lot for taking my question. I'll get back into the queue. Thank you.
Thank you. Thank you, Mukul.
Thank you. The next question is from the line of Dipesh Mehta from Emkay Global. Please go ahead.
Thanks for the opportunity and congrats for very strong execution. 2 questions from my side. First is about, can you help us understand whether Q1 played out in line with what you anticipated at the beginning of quarter, or played out better or worse? And if better, then what surprised us positively, if you can provide some perspective? Second question is on depreciation related thing. Can you provide purchase price allocation of SLK Global across tangible, intangible goodwill? How we did that assignment? Thank you.
Thank you for the question, Dipesh. Let me first request our CFO, Mr. Ajay Kalra, to take the depreciation question. And if you'd like to address question 1 as well, please go ahead, Ajay.
Sure. Thank you, Sudhir. On the purchase price, I'll go in the reverse order. On the purchase price allocation, we've done the preliminary assessment of our purchase price assessment for SLK Global. As you would recall, the total consideration for 60% was INR 920 crores. Total identified tangible assets net of liabilities were INR 192 crores. Identified intangible assets were valued at 315 crores. The goodwill we recorded was INR 615 crores. Does that answer your second question, Dipesh?
So it does answer. So only question is now 315 intangible, we will amortize over what period?
The amortization period would be approximately 10 years. It primarily consists of customer relationship and contracts, which is around 10 years.
Okay, thanks.
Thank you.
Yeah. There was a question preceding the second question as well. Let me take a quick stab at that. The question was, Dipesh, whether Q1 played out in line with what we expected. It was in line. It was broadly in line with what our expectations were. Getting into Q1, we knew that we were chasing a $100 million deal, and we haven't closed a $100 million deal at least in the last 4 years as an organization. So the fact that we were able to close it was not a surprise, But in many ways, it was a validation of the efforts that have gone on over the last 4 years in recreating the technology stack and the domain stack of the firm. Because, and I've said this in the past, and Ajay has also referenced this, because the revenue has seen such a spike, utilization has gone down because of the investments that had to be made to start staffing these deals. So they aren't surprises, but those are the two aspects: the very, very sharp and accelerating revenue growth leading to a lower utilization. Wasn't a surprise, it was a conscious decision, but it was a little away from what we had built in around our utilization plans for quarter one.
Thank you. The next question is from Sandeep Agarwal from Edelweiss. Please go ahead.
Yeah, hi Sudhir. Good evening and thanks to your whole management team for taking my question, and I congratulate you on 3 fronts: on excellent quarter, upgrade of guidance, but more importantly, on the bold call of taking margin hit, but you have retained your employees and you have kept your attrition under control. But I also want to ask you a question that probably Mukul also asked, but I will ask it in a little different way if I can get something more out of it. But with the order book which is up 38% year over year, travel opening up, demand supply massive mismatch. I don't see that mismatch could be met anytime soon, and your attrition being lower, so you obviously have good amount of talent with you already. Why you are so giving such a weak guidance of 19%? And I understand that you may have built in something for wave 3, or even biggies like banks companies are massively under guiding. So I'm not blaming anything on that part, but what I'm trying to understand is there really some worry which keeps you holding to give this 19% guidance, or you just want to be keep surprised for the investor every quarter? Because it will be almost impossible to achieve 19% unless we do some big blunder or you are aware of some big client loss or something. That is what my worry is, because I think with this kind of order book and travel opening up, everything going in our favor means 23-25% is something which is like we will not have to make much effort to do that, because your people are also with you. You don't have a high attrition in the key people. So can you please help us a little bit on that?
Thank you for the question, Sandeep, and thank you for your comments as well. I just want to reiterate, and I think I said this earlier, we do not have any worries linked to headwinds around the potential client loss or an existing revenue stream loss at all. I want to be absolutely categorical about that. We've never lost a material client, at least over the last 16, 17 quarters that we've all been getting together and talking about performance. And we really see nothing of that sort on the horizon at all. Our guidance, and I want to underline it and double underline it again, is at least. We haven't said, unlike EBITDA, we've given a fixed number. On revenue, 1, we have taken it up by 2% from the last quarter. 2, we continue to qualify it as at least 19%. As both of us recognize, and I tie this back to Mukul's question as well, it is going to be a dynamic number. We have the next 2 or 3 quarters to continue to assess how the market progresses, how our deals progress. And if there are further upsides, we will continue to keep revising our guidance on the revenue side. 19%, I would encourage you, given the way we worded it, also to look at it as a threshold. That's what we are calling out, Sandeep, but there is no material headwind that is playing into any other commentary around revenue guidance.
Sorry.
Go ahead, Sandeep.
So, and second thing which I wanted to know is, after how long you are seeing a position in the client market where pricing power is coming back? Is it a decade or more?
That's an interesting question. There's always been pricing power whenever a firm or whenever we've been able to stand up a bunch of SMEs who delivered clear, quantifiable impact to the client. So it's never been a situation where things were so bad that you couldn't go back to a client after doing excellent work or after providing for an exceptional SME pool and not ask for a revision. COLA has been built into a lot of our contracts, and there have always been ongoing conversations. That trend has intensified over the last 12 months. Let me make sure I get this right. The way I would put it is, in the last 7 to 8 years, this is possibly a point in time where the ability to go back and have that conversation and have a very high conversion rate is the highest that I've seen over the last 1 decade. That is how I would call this out.
Thanks a lot, Sudhir, for taking my question, and best of luck for the future quarters. You have an excellent team in place, and you have retained all your people, so congratulations once again, and I am very confident that your at least 19% threshold will be beaten very, very significantly. Thanks.
Thank you, Sandeep.
Thank you. The next question is from the line of Vikas Ahuja from Antique Stock Broking. Please go ahead.
Hi, thanks for taking my question and congrats on a good quarter. My first question is, on client concentration, which continues to improve. We have seen top 10 clients' contribution coming down from roughly little over 40% to close to 36% now in 3 years. But you think we need to use the same template for vertical-wise exposure as well? BFSI is more than 50% of total revenues now, post-acquisition. Are we happy with that kind of exposure, or you think we need to diversify over time? And second one is, as Vibhor mentioned earlier, we are 10% behind pre-pandemic run rate on travel vertical. Do we still think from here travel will continue to lead the overall pack, assuming Europe follows US maybe with a lag of 3 to 6 months? And also, last quarter you talked about a couple of large deals we have won in that in the travel segment. Have the ramp-ups already come this quarter, or those will be coming next quarter? Thanks a lot.
Yeah, thanks for the question, Vikas. I'm going to take a quick stab at them, and if Ajay wants to come in, I'd request him to also come in on the question. Client concentration, you're right. Top 10 are now 36%, and we feel very good about it. We've always believed as an organization that the biggest risk for a firm our size is putting too much of our figurative eggs in a single client or a few client baskets. So the fact that client concentration is low gives us very significant confidence that growth will be sustainable in the medium to long term. We always talk about robust, sustainable, and profitable growth. And the sustainable growth largely drives off the fact that we do not have high client concentration. Your comment around the fact that we need to mirror what we've done on the client concentration side, on the vertical side, is something that we recognize and something that we have been pursuing. If you look at us as an organization, and I called it out, there are 3 verticals that have been created over the last 18 months, which are now somewhere between 7 to 9% of our global revenues. And we made very, very concerted efforts at standing them up and a lot of investment. And that process will continue. BFSI, while one can club it together as one vertical, the way we look at it is BFS and insurance have very different dynamics at work. Insurance is roughly 30%. BFS on the technology side is 16%. Given the large deal that we've signed, $105 million on the banking side, we expect BFS to pick up pace very significantly and to be driving growth for the firm, which has not been the case in the last 2 or 3 years. So banking should be a clear growth lever. Insurance continues to have a very differentiated and a story that spans product, platform, and services. That should continue on the growth curve it is. And travel, because our expectation is that the growth that we've seen over the last 4 quarters, post quarter 1 last year, is likely to sustain in the medium term that pattern. There may be ups and downs in a few quarters here and there, largely because we believe the full recovery from our vantage is not played out because Europe travel has still not recovered. Recovery has largely been North America travel and APAC travel centric. So that's answered the question number 2. Question number 3 around travel, we talked about 2 material deals which were won in travel in quarter 4. And I did talk today about the fact that 2 out of the 4 material deals are expected to complete transition in the current quarter. They happen to be the 2 travel deals that were signed in the previous quarter, where we had placed SMEs, and they will now move to steady state operations starting quarter 2. Did I answer your questions, Vikas?
Yes, this is very helpful. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Rishi Jhunjhunwala from IIFL. Please go ahead.
Yeah, thanks for the opportunity. Most of the answers have been questioned. Maybe a couple. One, can you give the data points on revenue and margins on your NITL, which is Advantage 2 and Vishworks that you typically give every quarter in case I have missed out?
Sure. Ajay, would you like to give it, or would you like me to go ahead on that?
Please, I can give the numbers. The Advantage 2 revenue for the quarter was INR 750 million. EBITDA was 16%. And for Vishworks, the revenue for the quarter was $689 million, and EBITDA was 15.5%. Another thing which I would like to add is that Vishworks equity 100% owned by Coforge after the residual equity stake will be acquired in FY22.
Understood. Thanks. And just secondly, Sudhir, can you give some clarity in terms of comments that we have made around capital in the sense our main investor looking for a sponsor ADR. You have made some comments in the morning as well. Just wanted to understand basically if what kind of plans are they looking at on that front, if that is something you can share.
Sure, Rishi. As we shared earlier, and as we shared earlier this morning as well, the board has passed an enabling resolution on the 6th of July, and we had shared details of that resolution with everyone. Our assessment, the board's assessment at the current point in time is that we do not have any primary requirements which we are pursuing as part of the process. The board's assessment also at the current point in time under this enabling resolution, which is still awaiting approval by the shareholders, and that process will complete on the 30th of July at our AGM, is that if the board were to decide to go for the issuance of depository receipts, we would prefer to do it the ADR route and not the GDR route. So that's where we stand currently, Rishi, around the enabling resolution passed on the 6th of July.
Understood. So that's basically, conversion of the locally listed into ADR, no impact on our primary capital, right?
Yeah, at this point in time, the board believes that we do not have primary requirements that need to be serviced.
All right. Thank you. All the best.
Thank you, Rishi.
Thank you. The next question is from the line of Sudhir Guntupalli from ICICI Securities. Please go ahead.
Yeah. Hi, Sudhir. Thanks for taking my question and congrats on a good quarter. So if you look at the receivables, right, there is a 200 crore increase sequentially, and that is more or less equal to the sequential increase in overall firm revenue. Across industries and across companies, we understand that as growth is coming back from a low base, some amount of working capital is getting absorbed back into the business. But in our case, the quantum of this increase seems to be pretty high. So if you can give some more color on whether we are witnessing any change in the working capital terms for new contracts, or if there is any change in the revenue recognition policy, or if the trend is being driven by any one particular vertical. Because incidentally, another competitor of yours with high exposure to travel has also witnessed a similar trend this quarter.
Thank you for the question, Sudhir. Ajay, can I request you to take that, please?
Sure. Thank you. The increase in the receivables which you are seeing includes the SLK Global. There is no change in the DSO of the firm. and the overall composition of the terms, the payment terms, and the overall operating cash flows and capital structure, working capital. So it's just the addition of the SLK Global that is driving the increase, an absolute increase in the receivables.
Okay, but I would suppose, I mean, if you're the revenue also got added, right? So in terms of if you're looking at the incremental revenue at overall firm level, so are we suggesting that SLK Global has a much different working capital profile than what we have in the core business?
No, we are not suggesting that. So there was there were some payments that got delayed in India government because of the pandemic, second wave pandemic, to the tune of approximately $5 million. That will get recovered in Q2. However, in Q1 there was an impact. And in addition, I just want to also add that if you would look at the Q4 of FY21, the OCS was 144% of EBITDA, which was significantly higher, and we had a significant good collections in Q4. And on that of that, the next quarter obviously has some headwinds because of the higher collections in the previous quarter. On a overall period basis, it evens out, but there are no changes in the payment terms over the last couple of quarters.
Okay, Ajay. And just if you can repeat the intangible assets, did you say it is 315 crore and goodwill is 615 crore?
That is correct. I'll repeat the numbers once again. The overall purchase consideration for 60% was 920 crores, as you're aware. Total tangible assets were 192 crores. Intangible assets were valued at 315 crores, and the goodwill recorded was 615 crores.
So we are also considering the future payouts related to this, right? On top of 920 crore, because obviously these three will add up to more than 920 crore.
That is correct. The future acquisition cost has been recorded at 213 crores, and there is the non-controlling interest, which was recorded at 102 crores.
Okay, thanks. That's it from my side. All the best.
All right. Thank you.
Thank you. The next question is from the line of Ashwin Mehta from Ambit Capital. Please go ahead.
Yeah. Opportunity and congrats on strong growth this quarter. Sudhir, just one clarification in terms of the deal flow. We were talking about last quarter that we are chasing 350 million plus deals, of which one was a 100 million deal. So that 100 million seems to have been signed. But in terms of the other two, does the deal flow this quarter include that, or we are expecting decisioning on that to happen in the subsequent quarters?
One of those two has been converted, and they were referenced in the two other large deals that I talked about as well. There's another one that is still in play and continues to be in play.
Okay, fair enough. And just a small follow-up in terms of, we had earlier talked about that Esop charges this year would be almost 50 bits lower than the last year. So this quarter there was an increase in terms of Esop charges. So do we see going forward a normalization of that, and do we stick with that 50 bit reduction in terms of Esop charges?
Thanks for the question, Ashwin. Ajay, can you take that, please?
Yeah, sure. Thank you, Sudhir. The increased cost of MIP basically includes the grants given to the leadership that was hired during the quarter, including the leaders of our recent acquisition, SLK Global, at the higher market price. We do expect that the overall ESOP cost would be at approximately 85 bits instead of the 60 bits which we had guided earlier for the financial year 22.
Okay, so it's 85 bits for the financial year that you're now looking at.
That is correct.
Okay. Thanks a lot and all the best.
Thank you. The next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for giving me the opportunity again. Just one question to be on the demand side. If you look at more than 50% of your portfolio, which you indicated product engineering, cloud, digital, intelligent automation, are in high demand, and you believe there could be a multi-year demand for the same as a whole. So I'm not asking for a guidance, but do you believe any reason not to believe that the organic growth momentum, what we are seeing in FY22, can even continue in FY23 if there are no major COVID-related waves or no other macro-related risks as a whole? So I'm not asking for guidance, but directionally, you believe this kind of a growth momentum can be sustainable beyond FY22, or do you believe FY22 is a year of pent-up demand and growth may naturally come down a bit in FY23?
See, Sandeep, even last year during the pandemic, if you take out the travel vertical, right through the pandemic, the rest of the business outside travel for the firm grew at 18.4% organic CC terms. Pre-pandemic, the previous 2 years, we were growing at about 16% CC organic. And we were, of course, putting the building blocks around the tech stack build up in those first 2 years. Year 3, during the pandemic, other than travel, we still delivered 18.4% CC organic growth. Travel for us is a very big vertical, but we did it. This quarter, clearly, we called out 19+%, and we'll see where we finally land up. Our intent as a team, as an organization, has always been to discover a path to sustainable 20% organic CC growth. But that's an ambition. That's not a guidance. We believe there are clear paths to that journey, to that destination that exist. We have seen organizations which are not necessarily India-based in the IT services space create those and be on those for the past few years. So we are attempting, and we are putting in everything that we have to try to get to a model where we can start delivering those growths on a sustained basis. Are we confident? And just to close, are we confident that we found the path already? I think the answer is no. But are we very, very intent on trying to get there at some stage? The answer is a clear yes.
Okay. And just second question for maybe you can answer overall for the industry as a whole, because looking at the supply side attrition are real issues, and the mitigating factor could be clients' acceptance for the pricing as a whole. But for the industry as a whole, if you look at 50% of the portfolio is digital, 50% is legacy. And you also said pricing increase are coming in pockets for specific engagement rather than across MSA as a whole. So net you believe to be a net increase on the realized pricing at console level may not be very high, or you still believe the pricing increase on niche skills could be actually surpassing the pricing pressure which we may see for a legacy portfolio as a whole?
I think the blip that we've seen on pricing is likely to be temporary. I do not in the medium to long term see pricing as something that's going to keep going up. At some point in time, that leverage will start decreasing and we will come back to near normal levels where pricing is something that needs to be negotiated on an ongoing basis. To my mind, the bigger margin lever that we will have available to us as an industry will be one, making sure that we start eating our own dog food and inject automation in back office operations with the same intensity with which we've been able to inject it into some of our client organizations. Second, with deal sizes progressively going up, and I'm talking in relative terms, for mid-tier players like us, offshoring itself is going to be a very significant lever around margin increase, given the historical offshoring percentage levels that mid-tier firms have had and where they can land up if we continue securing the large ticket deals that we have in the recent past. So that's how I would represent margins as we see them from our vantage.
Okay. And last, just a bookkeeping, CFO has said 102 crores on a purchase price allocation is towards what? Because your voice was feeble. So 213 is towards earnout, 102 is towards what?
The 102 is towards the non-controlling interest because of, if you would recall, for SLK Global, we had acquired 80%, where we had acquired 60% upfront and contracted to acquire another 20% after two years. And the balance 20% is considered as non-controlling interest, and that's the 103 crores.
Okay. Thank you.
Thank you very much. That was the last question. I would now like to hand the conference over to Mr. Sudhir Singh, CEO, Coforge Limited, for closing comments.
I'd like to reiterate the gratitude of the team, all 20,000 plus employees of Coforge, to all of you for having made the time for this conversation. It's late evening in India, at least. We also thank you for your interest and for the comments and the insights that we continue to pick up from our interactions with all of you. I look forward to speaking with you along with Ajay 3 months from now. And we hope that you, your families, your friends, your teams stay safe over the next 3 months and beyond. Thank you very, very much for your time and for your interest once again. Bye-bye.